Hey everyone, I think we'll get started here now. I'm sure a few more people will be joining us as we get going here. I want to welcome you all to our program this morning. My name is Steve Kalina. I'm the President and CEO of the Minnesota Precision Manufacturing Association. Just some housekeeping before we get started. Some exciting times at MPMA right now. Legislatively, of course, we're right in the middle of session right now. I just testified 2 days ago, I think, on the recreational marijuana bill and trying to focus on some clarity on testing and safety that's needed. So that obviously, with a democratically controlled House, is passing through, and that will have no problem getting through, but most likely get stopped in the Senate. We're also putting a lot of focus on cybersecurity and having lots of talks with legislators on that, and actually just listened to a bill being proposed by the chair of the Technology Committee, Senate Technology Committee, and launching a new cybersecurity legislative commission. So getting some support there. And then also working on getting support for existing workforce programs that are currently at budgetary risk. So making sure that those programs are protected. Our academy, our skill training academy, is already launching our second student cohort this spring here. They're in process of prerequisites now. So we starting classes at Hennepin Technical College in the middle of March. I'm going to apologize because my 4-year-old is having a meltdown in the background. So hopefully you guys can't hear him too much. Trying to get him out of the house right now. And then, of course, we're getting closer and closer to holding face-to-face events. So I hope you can join us for our next programs, March 11th with DEED on hiring difficulties in manufacturing. I listened to that program last year, and I swear they did a whole research study and presentation just for our association because it was all about machining and the hiring challenges. So it was a pretty amazing presentation speaking right to us. So I hope you can join us for that because like I said, it's like they did it just for us. March 25th, then we've also got a webinar on real estate resources for expanding your business. So today's program is part of a series focused on transitional planning. Aside from our urgent labor needs that we're right back to as companies are so strong as they were just before COVID. Really, the second priority is business transitions and helping companies figure out how to figure out the next stage in their ownership, and whether it's family transitions or private equity or or maybe an ESOP. So we're focused on finding ways to help support businesses in their transitions. Today's program is kicking off that series with CBiz, focusing on transferring your family business. The presenters, David Levi from the Senior Managing Director at CBiz MHM, has over 38 years of experience in public accounting, working with small and large companies alike in areas of tax consulting, planning and compliance, and family wealth planning. And then Brian Barsi is the Managing Director at CBiz and has over 22 years of experience in public accounting and has been with CBiz his entire career. And Brian specializes in working with manufacturers in financial reporting, cost accounting, internal control procedures and processes, and corporate taxation. Brian's a very active member of MPMA. You'll see him at a lot of events, and he actually currently serves on our government relations committee as well. So while we're going through the presentation, please feel free to use either the Q&A or chat function to ask any questions, make any comments. We'll hold those for the Q&A session at the end, or if they appear to be very timely or something you want an immediate answer on something, the presenters are happy to break in and we'll pose those questions at that time. So please feel free to use those functions. So now I'm going to hand it over to our presenters, and we'll start with David.
Thanks, Steve. Good morning, everybody. Really appreciate the opportunity to chat with you folks about what is an incredibly important topic, ways to transition your business. And for the primary focus of today's topic is going to be transferring it in the family, keeping the business in the family. But many of the things that we'll talk about also affect whether or not you choose to sell to a third party, anybody who is currently working in the business, a competitor, a strategic buyer, et cetera, et cetera. But just kind of as an overarching focus or starting point, it's really important to note that for many of you, your business is going to be your largest asset, both financially and in many cases emotionally. And what you do with it and how you transition it and how you continue to steward it is it's a monumental task, and it's It's got emotional tentacles, it's got financial tentacles, it's got family, and it's got community, and it's got employee tentacles, and is really, really critical to get done and get done right. You're probably only going to have one chance to do it. And what we want to make sure of is that you can be in the best position to be in control of the events that determine what happens with your business, rather than having the events control what happens to your business. So with that kind of background, I'll just kind of start talking about some of the more specifics. Big picture, when you get rid of your business, you can do it in one of three ways. You can give it away. In other words, you can get nothing for it during your lifetime or in exchange for it. You can get something for it. You can sell it to children or other family members or other folks, or you can do a combination. You can maintain some ownership during your lifetime and also get some value for it. When we talk about giving it away, probably the simplest thing to do is you own it until the time you pass away. Your will says at my death, my business goes to X or Y or Z, child or children. And that can be an easy way to deal with it, or frankly, the way to not have to deal with it during your life, but can also be catastrophic because there's no planning, there's no management of that process. The second alternative is to give it away during your lifetime. Again, that presumes that you're not necessarily looking for any value. And Brian will talk about some of the valuation issues, and we'll talk a little bit about some of the gift strategies that we can look at as we get further into the presentation. The second alternative is you can get something for it. You can sell it to your child or children, or you can sell it to another family member, or you can sell it to a third party. You can do this during life, or again, there can be a valuation mechanism and there can be a plan to have it sold at death. We'll talk a little bit about the different tax consequences that will happen if a business is sold during life or at death as we continue through the presentation. Third alternative is you can get rid of the business from a gift and estate standpoint. In other words, the value of the business can be outside of your estate. But if you're of a means to do so and of a mind to do so, you can, in some cases, retain the responsibility to pay the tax on the results of the business. For the appropriate situation, this can be very effective from a family estate planning standpoint. And really, each situation is unique. But what's really important to really keep in mind is, as you look at how you're going to transition your business, don't try and pigeonhole it into particular strategies that you might have heard about. The real issue is identify what you want to happen, identify how you want it to happen, and then let your professionals work with you to make some of those strategies as effective and tax efficient as possible. Sarah, can you move to the next slide, please? Thanks. Factors to consider. I'm a huge advocate of the fact that you can never start planning the sale of your business too early. There are always going to be things that are going to come up, but I think that the appropriate way to look at your business as a stewardable asset and part of the community is to always have kind of one eye on what's going to happen with it when you're no longer involved. One of the most important things that businesses should have and should be continuing to monitor, and again, we'll talk a little bit about it a little bit further on, is a buy-sell agreement. Now, many of you may own your businesses 100% yourselves. In other words, you don't have partners, but still having a transfer agreement, and again, whether it's in your will or trust or what have you, is really important, so that if for some reason you're not around when things require the transfer of the business, that there's some plan in place. These plans are going to morph, they're going to change. And it's just important that you spend, we oftentimes talk about spending time on the business and spending time in the business. Many of us as business leaders spend tons and tons of time in the business, making sure the business runs really well and really strong, but we don't spend a lot of time on the business itself. And I encourage you to keep that factor in mind. Build the right team. And again, this is kind of a scalable concept. Depending upon the size and focus of your business, you may have a very, very small management team and operations team, or you may have a very large one. But as you build that team, you're really looking at that both with current goals and objectives of how the business is running, as well as future goals and objectives. Sometimes that may rear its head when you bring in non-family members. When you bring in non-family members into growing opportunities in the business, there may be some uncertainty. There probably will be some uncertainty as to, hey, is this thing going to always stay in the family no matter what? Or if I'm coming in to run a particular division or run a particular area, do I have an opportunity to either purchase some or all of the business? And I think that having those conversations sooner rather than later leads to more openness, more transparency, and more importantly, making sure that people are kind of all rowing in the same direction. Anticipating tax implications. You know, right now we're in a state of flux with capital gain rates and estate tax situations. We've come off of 4 years of the Trump administration and some fairly significant reductions in income and estate tax rules. The Biden administration has talked about reversing some of those changes and in many ways increasing the income and estate tax costs of business owners. And that is something to think about as you look at what goes on with your business. It's also important when you look at your retirement planning to do some financial modeling. Again, for many of you, this is the means of earning a living. This is the means of creating your wealth and your financial success. And it's important to keep on top of at what point you feel that you can either start to take less from the business, allowing others to take more if you're going to step back and reduce your responsibilities, reduce your involvement, perhaps reduce your ownership. And it's important to make sure that you don't leave yourself short. So we always encourage a separate financial modeling to make sure that when people are looking to sell their businesses, they're not leaving themselves short or not going to have any financial problems that way. Control versus ownership is one of the things that in my career, I've had probably the most conversations with closely held business owners about. You can maintain control of the business without maintaining a significant ownership stake. For some businesses, that might show itself as voting and non-voting ownership. In other words, the company may have 100 shares of stock or 100% limited liability units, but there might be 10 of those that have a vote or have operational control, and 90 of those that are merely an opportunity to share in the value, share in the results, share in the growth of the business. And as you look to transfer, you can transfer the ownership and transfer the value, which can be an effective estate planning strategy and things like that, while retaining the control. Similarly, you can look at shifting some of the control while retaining more of the ownership. In some cases, folks want to maybe give that second generation a little bite of the apple, a little bit of voting ownership, but not too much and not too much value. One of the things that we'll talk about is looking at changing ownership over phases. And when to start, there's no right answer. It's all going to be very specific to your own particular situation, but when to start thinking about it. Again, what do they say? When's the best time to plant an oak tree? 30 years ago. When's the next best time? Today. I think this is something that really needs to be on the mind of every business owner and needs to have some degree of focus all the time. At some point, you're going to go from thoughts about it to formal succession plans. And even those formal succession plans are going to be in pencil. You're going to find that, well, I think Billy might be the right guy to take things on, and Sally might be the right person in sales, et cetera. But you have to understand that plan A may not work. You need to give plan A an opportunity to work and nurture it and try and figure out how that can be successful. But you need to give yourselves time to go to plan C and potentially plan B as well. Because again, as I mentioned, the business is critical to you and your family, but for many of your businesses that have been around for a long time, they're also integral parts of your community. And you've got employees that are relying on you, and vendors and customers, and it's a very, very important asset to manage and steward appropriately. Sarah? Spend a fair amount of time talking about the business itself, but owners of businesses are people, and businesses are a part of their lives. They're not the entire life. And for many families, there is a combination of business and non-business, and many families have family in the business and not in the business. And I know that we're going to be talking about this in a lot more detail at our June presentation called Navigating Transition Productively. And more of what I want to talk about is kind of the tax and financial aspect of it. But I really do think that it's important as you go through it to keep in mind that the families and businesses are live, living, breathing aspects. And while it's important to get the right financial result for the business and for yourself, to look at it in a vacuum would be inappropriate. And so it's really important to look at how your ultimate decision to transfer your business affects the family. It affects the dynamic and the interaction of not only the family today, but what those next generation relationships are going to look like after you're gone. I talk about equity versus equality. For many of my clients, if a family has a net worth of X number of dollars and they have 4 kids, the theory is, well, we take X, divide it by 4, and that's what each next generation or each next generation family line ought to get. I think in the family business world, it's also important to look at the concept of equity versus equality. What's fair? And how do you want to make sure that if you've got family members that are in the business and are going to run the business and are going to have and are taking the risk and are devoting their time and energy and effort to it, that ought to be, it makes perfect sense that ought to be what they succeed to. But then there is the issue of how do we true up, if you will, wealth transfers for other folks that are not in the business, yet not hamstringing the business itself. And again, our goal is to make sure that we're doing everything we can to increase the likelihood of success for the business and for the family. Thanks. First, I want to introduce some terms and some concepts that, again, that we'll go into a little bit more detail. But the first issue is an asset sale versus a stock sale. And for many of your businesses, if you look at the financial statement, and again, Brian, I'll go into this in more detail, the business is worth far more than just the assets that are on the balance sheet. And when you're looking to sell the business, if you sell the assets of the business, that can end up generating some capital gain for the seller and can generate some opportunities for the buyer to get some depreciation deductions or some amortization deductions for the actual assets that they're buying. If, on the other hand, you do a stock sale and I sell you the stock of Levi & Co., that will generally get the seller more capital gain, but in most cases will not be anywhere near as tax efficient for the buyer. And when you are looking at what a buyer is willing to pay, part of what goes into that analysis or decision is how friendly or unfriendly that transaction is going to be from a tax standpoint, and what kind of deductions and what kind of partner Uncle Sam is going to be with that transaction. Again, I talk about buy-sell agreements. It's just really important to have some kind of reference point for what's going to happen with the business in case an unanticipated event happens. I have many clients who set up their businesses 15, 20, 30 years ago, and the buy-sell agreement says, well, we're going to sell the business at book value. Well, book value is the net of your assets and your liabilities, which may tremendously underestimate or understate the value of the business. Might be a terrific win, if you will, for the buyer, but it could dramatically hurt the selling generation and or the estate of the seller if the business is actually sold as a result of the passing of the owner. Seller financing can be in place. In other words, there might be some cash payment and the current owner can take back paper and allow the buyer or the company to pay for the business over time. And the AFR, which is what's called the applicable federal rate, is a rate that the IRS puts in place, which is the lowest legal rate that you can charge and not have any gift tax consequence. Oftentimes, if people are trying to create an attractive environment or create a discount, if you will, on the transaction, whatever seller financing that's in place may be done at the AFR rate. On the other hand, if the sale of the business constitutes some risk, and a higher market rate of interest might be appropriate. This third idea of a self-canceling installment note is an estate planning strategy that allows for any remaining balance on the installment note at the death of the seller to go away. Can be used in some pretty specific situations, but I just wanted to raise it in general so that folks are aware of the concept. It's really important. I mean, again, we're talking here about preservation of wealth of the senior generation, and if they are receiving note payments or if they are taking cash proceeds and investing it, it's just really important that the selling family member, that their financial security has been accounted for. And that's why, as I mentioned earlier, it's important to make sure that you do your modeling to make sure that there's the right mix of taking cash off the table, as well as making sure that the business can support whatever payments are going to be continuing after the sale. From a non-financial standpoint, again, the role of the selling owner or owners during the selling, during and after sale is a really important factor. In order to make sure that there's the greatest likelihood of success in the transaction, we really need to have both buyers and sellers on the same page with what the right role is of the selling owners after the buyout. One of the most important things that I think sellers need to be looking at, in addition to the financial piece, is what are they going to do when they're no longer going to work every morning. And having said that, that's not to say that there aren't times when the sellers won't get rid of their ownership, but still maintain an active role in the business. And it's just really important that all of these things be on the table, be discussed, and be agreed to. Brian, you want to step in and talk about some of the valuation issues we'll be facing?
Yes, thank you, David. So as part of any strategy to transfer the business within the family, there's going to need to be a valuation performed. So the next session in the business transition series, we'll have our valuation experts come in and take a deep dive into these valuation methodologies. but we thought it was important to give you a 30,000-foot overview of the valuation processes here. So to start off with, the valuation standard used is fair market value. Fair market value is the price in cash at which a willing and able buyer and a willing and able seller would exchange the business for as a going concern. This assumes an arm's length transaction. It assumes neither party is under compulsion to buy or sell. It also assumes both parties have reasonable knowledge of the relevant facts of the business. In short, it's a value determined in a perfect world. Now, there's three methods to determine value. These methodologies are the income approach, the market approach, and the asset approaches. These approaches can be used exclusively, or they can be combined and weighted in different values to value your business. Within these three main approaches, there are different subset methodologies. Now, one of these methodologies is the asset approach. We won't discuss the asset approach in detail because it'd be rare to use this approach in the context of passing down a family business. This is because your business is going to continue as an operating business for the next generation. You typically would only use the asset approach if the company was to be liquidated. Think bankruptcy, or there is some other unique factor. An example would be a street parking lot in downtown Minneapolis. That business typically has more value to a developer than as an operating business. It's better off dead than as a live business. Next slide, please. Now, the income approach, that's a better bread and butter approach for valuing closely held businesses. The income approach accounts for three things: earnings, growth, and risk in its model. As part of this approach, there will be market research done to look at the current economy as a whole and how this income impacts the value of the business. As shown on the previous slide, there are two main methodologies under the income approach. The first is the discounted cash flow approach, and secondly, there's the capitalized earnings approach. The capitalized earnings approach is when a single period of income can be assumed and calculated for a company. This single period of income is then divided by a capitalization rate, which factors in growth of the company. This capitalization rate is based on various market and company-specific factors. This approach works well with a mature and stable company. Now, the discounted cash flow approach works in a very similar way, except that you project multiple future periods of income versus a single period of income. These future periods of income then are discounted to a present value. This approach is typically used when a company is less mature or has more volatility in its income streams. Under both of these approaches, the development of cash flow forecasts will be critical because your future cash flows are more indicative of the value of a company than your past results. So the forecast will be your main drivers of value. Now, part of the forecast process will be to normalize your income for discretionary expenses or large non-recurring items of income and or expenses. Examples of discretionary expenses in a family business can be owner compensation that isn't set at a market rate. It can be discretionary travel. It also can be vehicles that are used in the company that perhaps an outside buyer wouldn't have in the company. Other non-recurring expenses could be related to a one-time moving expense that you wouldn't normally occur in your normal operations. Or in this past year, a perfect example would have been a lot of companies have COVID-related expenses that are abnormal that you would take out of any modeling that you're doing as you're valuing your business. Now, when we look at these income approaches, they're going to take into the consideration of the growth of the company and take into inflationary factors. Now, this growth of your company is going to be based on the management projections and also take into account industry research for your particular company. Also, the models are also going to take into account for general economic risk, industry-specific risk, and risk specific to the company. So all companies aren't created equal. So if you look at a company, even in a manufacturing set, the risk related to someone who's in aerospace versus someone who is in medtech, those risks are related differently because the economic factors in those industries are different, even though they both have machinery and they're manufacturing companies. So if you could go to the next slide, please. The next approach is the market approach that's used in valuing companies. The market approach is commonly used in family businesses. Now there's two subsets of the market approach. The first is the public company approach. Now this approach is rarely used in valuing family businesses. And there's just too many differences in the size and complexities for it to be a valuable tool in the mid-market space. Quite simply, public companies don't look like mid-market companies, so it's rarely used. However, the mergers and acquisitions method is regularly used. The M&A method is based off private company transactions. Business brokers contribute actual private company transactions to databases that our valuation team has access to. These transactions are grouped by industry and the year of the transaction. So then the valuation team looks at these databases and they look at multiples to determine value. Ultimately, there are a few multiples that are most commonly used. These multiples are revenue, gross profit, EBIT, which is earnings before interest and taxes, and EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Next slide, please. So, practical implications. So, what does this all mean in the context of passing a business down in the family? You know, the business valuation is one of the building blocks in the succession planning model. End of the day, you're going to need to calculate the value of the business. It's important to keep in mind that the value of the business in a succession planning scenario is most likely going to be lower than the value you would get on the open market. If you're selling your business with a business broker or to private equity, the buyer is most often going to be a strategic buyer. That drives up value compared to the valuation techniques used in business valuation, which typically can be a good thing for the certain planning strategies that David has discussed. Because a lower value results in less estate tax, enables you to gift more. So it's a good thing from a strategy standpoint. Not only do you have these lower values, these lower equity values are then further decreased by discounts. The first discount is for lack of control. As David mentioned, a typical strategy employed in transitioning family businesses is to either transfer non-voting shares or voting shares that do not constitute the majority of voting stock of the company. If the shares transferred don't have control over strategic and operational decisions, the shares have less value than the shares that do have control. As a result, the values of these shares is discounted when they do the valuation. The second discount is for lack of marketability. I can go online after his presentation and sell my shares in 3M and convert it to cash immediately. I can't do that with my shares in the family business. It may take years for closely held companies to find the right buyer and the right price. This lack of liquidity creates the discount that's also taken when they go through the valuation process. So as a result, in addition to the discount for lack of control, a further discount is taken for the lack of marketability. Now, currently in 2021 and 2020, we have the COVID pandemic going on. So a lot of questions are being asked is how would this impact the valuation of businesses? Now, different businesses have been impacted differently. Some have grown, some have been impacted tremendously in the negative context. You know, the jury's still a little bit out on how this is impacting some of the discount rates, but certainly some companies that I've been involved, it certainly would impact their projections. So when you're looking at those discounted those cash flows of the future, so if you're an industry that's been impacted, those cash flows may be lower than they would have been 2 years ago, which would create a lower value of your company. So if you're transitioning it in the family, one of your goals is to minimize the tax impact of the transition, 2021 may not be the worst time to implement a strategy because the value of the business may be lower when they do the valuation of the work than it would have been a couple years ago because of those factors. So that's kind of a high level view of the business valuation concepts. And now I'll turn it back over to David.
Thanks, Brian. I'm very proud of myself for not having been the guy that says, "You're on mute, you're on mute." So thanks, Sarah. So as we've talked about, there just are a number of themes that really end up getting plugged and played into the strategy of transferring your business. As we've talked about multiple times, you can have voting and non-voting ownership. And it's important to realize that even right now, if your business has entirely voting ownership, if you're a corporation and all you have is stock and it doesn't declare whether it's voting or non-voting, or you're a limited liability company and all of your types of ownership are just one class or one type, separate and distinct from a sale or disposition strategy, you can go in and, working with counsel, create a second class of stock, create some non-voting ownership. You might own it. You might own 100% of both voting and non-voting right now. But as you start thinking about transferring the business, and now you have voting and non-voting ownership that you can dole out or you can sell, it provides for a lot more flexibility as you look through the different strategies to consider. Transfer of ownership can be in phases. I have a number of clients who make annual gifts of stock. We talk about transfer of ownership being gratuitous. And every year they might gift away to family members up to $15,000 or $30,000 if they're married in gifts of stock. From an estate planning standpoint, any person can make a gift to any other person of up to $15,000 and not have to file a gift return and not use any of your $11.7 million lifetime gift and estate transfer amount. And so for families that have established strategies, whether it's for a family business or whether it's for investments or what have you, they're making gifts on a regular basis and transferring ownership, in some cases, little by little. It can also be a terrific opportunity to start the discussion or start the conversation with an individual. Oftentimes, I know Brian and I each became partners in our firms, and we became owners. And for different people, being an owner of your business, even if it doesn't provide you any control or anything different on day two than it did on day one, being an owner is an important emotional and integral factor of how you feel about that business and how you feel about yourself and how you feel about your career. But doing it in phases and allowing an ability to dip your toe in the water, so to speak, can be another really important factor when you're looking at transfers of ownership. And one of the discount issues that's out there also, in addition to control and marketability, is minority interest. And so if I'm only owning 1% or 2% of the business, that also will have a factor in the valuation, whether it's something that I'm paying or something that I'm paying for or being given. And we'll go down a couple of bullet points and we can talk about some of that in the context of compensation. We talked earlier that when you're transferring the business, I as the seller can finance it, or the company can finance it, or the buyer may need to finance it and say, okay, I'm willing to sell you the business, but you've got to come up with the cash. And depending upon who or how that purchase price is going to be paid, can have a significant impact. I mean, let's be honest, in most cases, however it's structured, the business is financing the purchase, is financing the transfer from the seller to the buyer, certainly in a family situation. Now, that may happen by having the business increase the salary to the buyer so that the buyer has more money to pay the seller. It may be that the business will loan money to the buyer so that the buyer can then pay the seller, and over time, whether it's through dividends or through other mechanisms, the buyer will then repay the company or repay whatever the third party is to finance that transaction. There have been put in place some greater limitations on interest expense deductions at business and individual levels. So making sure that you factor in the overall tax consequence and how those things are structured is really important. A transfer can be part gift, part sale. I might transfer 15% of the business to you. I'll give you 7% and I'll sell you 8%. It may be important to both the buyer and the seller that the buyer has some skin in the game. It's, you know, a lot of people look at that when their kids go to college. You know, are mom and dad going to pay all the tuition, or are the kids going to use some of what they've saved during working, or are they going to take out student loans? It's important that the buyer have some skin in the game and make sure that they treat this as not just something that's been given to them. For purposes of compensation, there are also opportunities to use the value of ownership as a carrot and a mechanism in compensation. There are ways what people are familiar with stock options. Again, Brian used the example of 3M. A lot of times you'll read about, you know, corporate employees getting stock options as part of being an employee, and it gives them the option to purchase a piece of the business at today's price, and hopefully they can benefit by having the ability to buy it at today's price over a period of time when the company appreciates. It aligns the interest of the employee with the long-term growth of the business. There is another concept called restricted stock units, or RSUs. This is something that, again, is being used more with closely held businesses. Used to be done a lot more with public companies, but it might be deferred compensation. It might be a deferred bonus. It might be an opportunity to run with a new division. I'm going to reward you later on for the success that you actually generate in that business. It makes a person think like an owner when they realize that they're working not just for a paycheck, but part of what they're working for is the ultimate growth in the business. And the fact that the award of those types of items, can provide tax savings to the company without having to use company cash can make them even more attractive. And the last item I'll just mention is that you can transfer ownership by either me being the senior generation, selling to a junior generation, or by having the company itself buy my stock. And that's called a redemption. And what happens there is, if the company is going to pay me to redeem or retire my stock, then there are fewer units or fewer shares outstanding. And thus the ownership that everybody has in the company becomes more valuable because there are fewer shares outstanding. And again, there's some different strategies to go through those choices. Sarah? I just want to talk a little bit about the different types of ways that people operate their businesses and the ways that can impact the way that you sell a business. I think most companies that I'm seeing these days are structured as limited liability companies, or LLCs. They started in 1986. It's really a hybrid of a liability protected business like a corporation, with the flexibility and the ability to be taxed as a pass-through like a partnership. And again, I'm finding this in what I see to be the most popular ownership structure. And in most cases, LLCs are taxed as partnerships, which means that the owners are paying tax on or deducting the losses on the results of the business, regardless of the amount of cash that they take out of the business. One thing that we are seeing as a result of the 2017 Tax Act is some limited liability companies are choosing to be taxed as S corporations, which we'll talk about in a second. And what being taxed as an S corporation can allow, and it can be impactful as the transition happens as well, is that you can separate income that is subject to income tax from income that is subject to employment tax. And as a limited liability company owner, 100% of your share of the profits are going to be subject to self-employment tax. Whereas if you have a limited liability company taxed as an S corp, some of you put yourself on a salary, that share is taxed and is subject to payroll taxes, while your share of the profit, if you will, avoids being subject to payroll tax. Also, there is something called the qualified business income analysis, which also came into play in the 2017 tax bill, which can be more attractive for an S corp than for a limited liability company as it relates to ownership compensation. LLCs will and should have operating member control agreements that cover ownership and that cover what's going to happen when transfers happen. Oftentimes it will include and factor in the buy-sell agreement. Oftentimes there will be provisions that either mandate or eliminate the ability to use the discounts that Brian talked about for valuation and for transfer purposes. They're also going to talk about who can become a member and in what cases the approval of other members is required for any kind of transactions. And understanding how your member control agreements work is critical as you start embarking on a path to transfer ownership. Sarah, next slide, please. The income tax issues in a liability company is probably the best combination of the ability to get capital gain to a seller, as well as being able to get the buyer the ability to depreciate or amortize the value of the business. Brian talked earlier about using discounts to reduce the value and perhaps provide for some discounts going to the second generation. But what we want to also factor in is the ability to get income tax savings, and using the valuations and using amortization will enhance those tax savings. And also, I just want to note that a limited liability company can be in place just for a single owner. And in that situation, they're going to report on Schedule C, but still have the liability protection. Next is S corporations. And S corporations are very similar to C corps from a liability standpoint. One of the differences when we look at a corporation and transferring ownership in a corporation is that if you sell the stock in a corporation to the next generation, the seller can end up getting capital gain treatment, but the buyer can often be limited in their ability to generate additional depreciation deductions. So when we look at our S corporation transactions, we're mostly looking at asset sales, which would often end up with the buyer creating their own new entity to purchase the assets from the current entity and be able to get that step up in depreciation, because again, being able to get some additional tax benefits is going to make the purchase much more palatable for the buyer. One thing to note for the S corporation is that there are some limitations on the types of ownership, the types of owners that you can have, and that just needs to be looked at as you continue down the path. I'll just take a second to talk about C corps, because I don't think that we have very many of our current clients that are operating as C corps. They end up with double taxation to the extent that you want to take money out other than salary. But in a sale to a financial buyer or a strategic buyer, oftentimes they will operate as a C corp. I want to make sure we save some time for Q&A, so I just want to spend a little bit of time talking about what to do with real estate. Oftentimes, the owner of the business will also own the real estate on which the business is operated. And there are some tremendous opportunities to differentiate and transfer the real estate perhaps to certain family members that are not involved in the business, and provide an ability for those family members to receive rent and still get some value from mom and dad's estate. It's also an opportunity for the senior generation to retain an aspect and an income stream, so that that might be part of the senior generation's retirement planning, is to get rid of the operations of the business, but keep the real estate. What I am also seeing with some of my clients is that the real estate is a gifting opportunity for grandchildren. And again, it's just, at the end of the day, things are very specific within each particular family. But when we look at the operations of the business, when we look at the real estate that's used in the business, being in control of the situation, as I mentioned at the outset, rather than having the situation control you, can really help you maximize both the financial value and the emotional value of your business as you continue to have that business operate. That's what I have. I haven't been noting Q&A that have come up, but Steve, are there some questions that have come in?
Yeah, so actually the first one here, Kevin Sandstrom's got a great question, but it's pretty technical, and I don't want to just repeat it verbatim. I'll let him kind of speak to it. So I'm going to actually ask Kevin to speak here. I just gave him the ability to talk. So Kevin, you want to chime in? Can you?
Sure. Yeah. Thanks, Steve. Giving me a little bit of control here. So the question I had was about business multipliers, and I think that was part of Brian's slides, but dealing with a case involving a somewhat unique business in the agricultural sales, and just having discussions with business valuators in that case on EBITDA multipliers and how those things are created, and just found Brian's comment interesting about, there's these databases where private business brokers are typically inputting information in on other sales for use basically in the industry by folks like you on using those things to compare to an existing business and creating your own multipliers. And I just wanted to get a sense for if you have any idea how comprehensive those things, those databases usually are. Do you feel like most business brokers input their sales into those things, so you have a lot of confidence in them, or do you feel like there's a lot of sales out there that just remain secret and you never actually know about them?
It's facts and circumstances driven. So the more unique the business, the less apt you're going to use that. And when we talked about weighting those different methodologies, Kevin, that's one thing the valuation experts look at. So if they go to those databases and they see 15 transactions for that type of industry, they're more apt to use those databases in their valuation methodology. If they go there and they only see one, they're less apt to use that methodology at all and more rely on the income approach solely in their valuation mechanism. So you run across that, especially the more specialized the transaction and the target company is.
And so when you're doing these valuations for like MPMA members, for example, the types of businesses they have, would you consider precision manufacturing? Can you compare any type of business that might be a member of the MPMA, or do you get more specifically into subsets of precision manufacturing when you're trying to compare apples to apples and doing valuations?
Yeah, and we have once again, in our next session, we'll get more into the detail. But yeah, certainly you wouldn't look at all MPMA membership the same. You'd look into machine shops in a couple different subsets. It could be what type of material they use, for example. So typically, if you look at a lot of these, if you look at the NAICS codes, which for manufacturing, Steve may know more than me, but there's hundreds of those. Typically, that's how the data is segregated, is by the NAICS codes.
Okay, so you're going to look for business transactions for companies with the same code to really compare apples to apples.
Correct.
Okay, sure.
All right, well, we've got a couple more questions in the chat log here. I'm going to ask, I don't know if Linda from Precision Coatings, would you like to ask your question live? I'll give you the option to, otherwise I can read it for you. No, okay, it sounds like she'll pass on that. So I will ask that question. Find it again here. So if real estate held in an S corporation, or if the real estate is held in an S corporation, let's see here, I want to make sure I read this right here. Part of operations, how do you transfer this to get into an LLC, and what are the tax implications? I don't think I'm reading that quite right, but
No, I think I get it. I think I understand the question. If the question is, right now you've got the operations and the real estate both in the same S corp, how do you separate them out? It's difficult, and one of the reasons we don't, yeah, very carefully. That might be a situation where you would end up selling the assets of the operating business and retaining the real estate in the S corporation. Because if you take the asset, if you take an S corp, if you take real estate out of an S corporation and distribute it to its owners, it's really treated as a taxable sale. And that's one of the other differences between an S corp and an LLC. Is in an LLC, I can remove assets, in many cases tax-free, but if I take an asset out of an S corporation, it's treated as a sale. And so if the goal in that situation was to bifurcate or differ, or retain the real estate and get rid of the operating business, the better answer in the short term may be to sell the assets of the operating business, have the buyer create a third, a new entity to buy those assets, and then if you're going to retain the real estate in the S corporation, just retain it in there. From a long-term standpoint, we would look at, might look at other ways to try and minimize the pain of getting it out of the S corp over the long term, whether that's going to stay in the senior generation or move to the younger generations.
And then we had a question on if the multiple databases were in public domain.
I believe you have to pay for them.
Okay. How about, I know you covered briefly on buy-sell agreements. That's one of those things that I think you create initially, and then they maybe collect dust over the years, and then you probably have a lot of changes that go on before you actually get back to them. What do you have any recommendations on what kind of the trigger points are, or when you should be doing it, let alone when you need to do it or redo them?
Well, certainly a trigger point would be when you get involved in any sort of estate planning, but I think those things should be revisited regularly, especially when you have multiple partners, because things happen. I've had several situations where a partner unexpectedly passed away, and then you're looking at a buy-sell agreement, which really isn't. They wrote it when they thought everyone was going to live forever. So I'd say on a regular basis, and I'll let David comment. He probably has some comments on what frequency.
Yeah, Brian, I thank you. I really think they should be looked at annually. Doesn't mean that they need to be changed or modified, but business changes so rapidly, tax environments change so rapidly, family dynamics can change. I know that there are a lot of buy-sell agreements that we have seen that even provide, that have a mechanism that says that refers to a value. And it says if the value hasn't been updated in the last, pick your number, 12 months, 18 months, you're kind of stuck with an older value. And I think, especially if your buy-sell agreement has that kind of reference, whether you're looking at the valuation on a periodic basis or the terms and conditions of the buy-sell, I think a spin through it annually doesn't mean you have to get lawyers and accountants to spin through it annually, but your situation. And an annual review of all of your governance is never going to hurt you. It's always going to be a good investment.
And David made a good point when you talk about getting the lawyers and accountants involved. If you don't keep that updated and people aren't don't have a good understanding of it, when there is an exit, the lawyers and accountants will get involved, and often that gets expensive, and it's an emotional process.
Well, I think we're at our time now, and I think we covered the questions that were in the question or the chat log. So if anyone else has anything else, you can plug it in last second here. But otherwise, I want to thank David and Brian for presenting today and covering a lot of great information. I know a lot of it's reminders on things, but I think a lot of us need reminders when it comes to transitional planning, and maybe some nudges or more than that. So I appreciate great content, and of course, as you saw on the last slide, David and Brian are willing to connect and help have some initial conversations with anyone. So feel free to reach out. As you can see on the slide now, the next program we've got is April 22nd on how to determine the worth of your business. So another very tangible discussion and things that people usually like to jump right to when it comes to transitional planning, even though a lot of the stuff they covered today are the things you have to kind of talk through first. So the presentations from Chris Riley and Howard Kaminsky from CBIZ, and look forward to hopefully seeing you guys there. And again, look forward to seeing everyone in person. Thanks for in the near future, not for the next event. But thanks for joining us today and taking the time out of your day. Hope you all are doing well, staying busy and healthy, and look forward to talking to you soon. Thanks again.